Good morning, I'm Maiki Oreta, and you're watching Basis Points, where we dive deep into the numbers and the stories that drive our economy and shape our world. We begin with the Philippine peso further strengthening against the US dollar. The local currency hit its strongest level against the greenback in nearly 4 months. On Tuesday, the peso bounced back to the 56 level after opening at 57.25 and closing at 57.32 Monday. The peso started the year at 55 against the greenback, but then started depreciating in April amid expectations the U.S. Federal Reserve would likely delay its policy rate cuts this year. Back in June, the peso even touched a low of 58.86. In the U.S., producer prices fall short of expectations, albeit marginally, still reinforcing hopes of an interest rate cut next month. The index, which measures the selling prices producers receive for goods and services, rose by 0.1% in July. Economists had forecast a marginally higher increase of 0.2%. On a year-on-year basis, the headline PPI edged up 2.2%, marking a sharp drop from the 2.7% reading in June. Its counterpart, the Consumer Price Index, is set to be released Wednesday, U.S. time. Both indices, as well as retail sales data, which will be out on Thursday, are closely watched. Those figures are widely expected to support bets for a 25 basis point rate cut by the U.S. Central Bank. But a cut of 0.5 percentage points, however, is not being ruled out, though much will still depend on the August employment figures, among other key data points. The global demand for oil is expected to slow next year due to a weaker economy in China. The International Energy Agency trimmed its 2025 outlook, saying they now expect the demand to rise by 950,000 barrels per day. That's a decline of 3.3%. from its previous estimate of 30,000 barrels per day. The agency, meanwhile, left its growth forecast for 2024 unchanged at 970,000 BPD. The IEA notes while the weakness in China's economy will hurt consumption, this will partially be offset by a strong demand from Western countries, particularly the United States, where 1/3 of the global supply of gasoline is consumed. The OPEC, or the Organization of the Petroleum Exporting Countries, earlier cut its 2024 demand forecast, also citing the weakness in China as the basis for that decision. This as China is both the world's biggest oil importer and the second biggest oil consumer. Speaking of China, bank lending there is at its lowest level in nearly 15 years. Banks in China extended 260 billion yuan in new loans in July, down almost 88% from the previous month. That's also less than analysts' expectations of 450 billion yuan. The country's central bank says a slowdown in China's credit expansion is expected due to shifts in their economy and to less lending from the property sector and the local government's financing vehicles. The bank has vowed to guide credit to grow reasonably and to step up financial support for the broader economy, with efforts directed towards spurring consumption spending. Over in the United Kingdom, the job market there defies expectations of weakness. The UK's jobless rate fell to 4.2% in the 3 months to June from 4.4% recorded in the previous 3 months. But wage growth slowed from 5.6% to 5.2% in that same period. That's the lowest rate since May 2022. The figures are expected to influence the Bank of England's decision on interest rates when policymakers meet next month. Analysts say the data is likely to reassure the bank that inflation pressures are indeed easing. Over in the United States, Starbucks shares soar by 24%, this after the coffee giant named a new CEO. Now at the helm of Starbucks is Brian Niccol, the former head of the Chipotle Mexican Grill. Since joining in 2018, he's been credited for the surge in the burrito chain's annual sales. Niccol, however, faces several challenges, including increased competition and a weakening demand in top markets, the United States and China. Niccol starts his new role on September 9th, and with it, he will become the 6th CEO at Starbucks over its 50-plus-year history. We're taking a quick break. Stay with us as we dive deep into the numbers and narratives that matter most to your bottom line. Welcome back. You're watching Basis Points. U.S. indices hit a near two-week high after softer data on producer prices raises hopes of an interest rate cut this September. The Dow Jones and the S&P 500 both closed higher by more than 8%, while the Nasdaq rose over 2%. That's as the producer price index increase fell below expectations, suggesting that inflation continues to moderate.
I think the market now is kind of taking a deep breath, and we're just going to continue to digest the next economic data point. And I think that's what's going to drive markets the next couple months. You're going to see periods of quiet and then suddenly an eruption based off of some economic data point. And that'll push markets up or down based on really what that might mean for the Federal Reserve policy. And unfortunately, I think markets into the end of the year are going to be pretty much completely driven by Fed policy and the outlook, the crystal ball that everyone's trying to look into about what the Fed's going to do with interest rate policy this year and next year.
America's PPI data is also lifting market sentiment in Europe. The benchmark stock index closed at a near two-week high, as well at nearly 1%. Let's take a look at the figures at the Philippine Stock Exchange. Right now, the PSEi index is up by 0.3% to 6671. That's on the back of gains in pretty much all the sub-indices. They're all trading higher except for the property sector. Now, leading the gains in the PSE index in particular, that's the financial sector and the mining and oil sectors. They're up by about 1%. Now, to help us make sense of these numbers, we're joined by the Chief Equity Strategist at DA Market Securities, Nisha Alisher. Hi, Nisha. Thank you for being with us this morning.
Thank you for having me, Maiki.
Okay, so Nisha, interest rates are top of mind because the Bangko Sentral is going to meet tomorrow. The Monetary Board is going to meet tomorrow to discuss interest rates. Now, while it seemed to be a given that they'd start to cut interest rates, take a less hawkish, more dovish stance, July inflation had crept up to 4.4%. That might make them hold back at least for August. But if you step back and look at the bigger picture, the U.S. Fed is, seems on track to be cutting interest rates this September. It doesn't seem to be a matter of if, it's just a matter of when. And then there's the speed and the intensity that come into play. What are your thoughts on this?
Sure. Well, for the Philippine inflation, that's 4.4% for July, but year-to-date is 3.7%. So that's still within the range that they're looking at, 2 to 4%. Of course, it's still concerning. We'd have to look at the data after July to see what the trend is showing us. It is good news in the States that could actually, again, signal, an actual rate cut in September. Whether it's 25 or 50, we don't know what that is, or whether we're going to do a 25 BPS rate cut by tomorrow is also still a question. However, what does matter to us is that it is forthcoming, and it could be sooner than later. So I think when you're talking about a new change, a change in interest rate regime, a shift, then that would be what could signal a difference in the market.
That's right. I mean, but an interest rate cut, that's what could possibly support the market breaking out of the very narrow trading range we've been at for the past 2 years. We've been at a range of 6,000 to 7,000. How much of a rate cut would we need to support a break beyond that? I mean, at what speed and at what intensity? And then there's the U.S., right, coming into play. Can you help us make sense of that?
Sure. Well, for the U.S., I understand that they're probably going to need 100, 200 basis points to have a real impact in interest rate sensitive sectors. For the Philippines, there has been an indication that we can do 25 to 50 this year and then 100 next year. And this would already be very impactful in terms of inflation for us, I believe. Of course, it could take time. Again, as you said, it depends on the pace that they do it. We do think, however, that 2025 would be more optimistic for us. This would be converging with midterm elections, which we think should buoy up consumer spending amid slower inflation. So for the market in general, we think that there are more optimistic factors that could boost markets up.
Right.
Whether that breakout is going to happen, we'll have to see, but there are more positive indicators today.
And given those positive indicators, we can position for that. Because you want to buy, not when the market's up, you want to start accumulating right about now. Looking at the burst from the macro perspective, you mentioned the midterm elections, where also we've got Q2 corporate earnings have been good. We're at the cusp of a lower interest rate regime. We're entering a period of above average consumer spending given the holidays. And then even after that, we've got the midterm elections that will support that demand in consumer spending. How should investors position themselves in preparation for all the good things that are ahead?
Right, that's a really good summary of all those positive factors. We do think that we've seen property move already, the property sector, from the lows that it's seen.
Interest rate sensitive property and banking sector.
Well, banking sector will continue to do good. I mean, it's benefited from the higher interest rate regime, but as rates kind of come down, but not too quick, we think that loan demand will come in. At the same time, consumer discretionary should benefit after properties from that lower interest rate environment and also just higher consumer spending. We do think that confidence in consumer spending should still come back in, but companies are at record growth for earnings, and so that's telling you something for the future.
It's nice to be optimistic. Over in the U.S., still on interest rates. Over in the U.S., inflation is going to be out on Wednesday. Retail sales data on Thursday. While these figures in themselves won't move the needle, they will give us an indication, a firmer grasp on what the Fed is going to do with interest rates come September. What are the dangers necessarily of cutting interest rates before the U.S. Federal Reserve? I mean, what are the dangers of the BSP being ahead of that curve when it comes to monetary policy?
Sure. Well, when BSP signaled that possibility, the peso started to weaken. We do think that it would be a continuing concern if it would diverge. But we also think that we're kind of already in that timeline we're in. We could be just moving in tandem with the States. And also we've seen successful intervention by the BSP at the 59 level in the peso. And today it's much stronger. Japan cut their rate before the U.S. Markets have been reacting.
Rattled by what Japan did. Yeah.
That's right. But however, they're also doing it for what they think they need to do. And also Japan had rallied by so much, so it's also profit taking. That's fine. I think that's the normalization in the market if we're shifting already towards a different kind of period.
Okay, you mentioned the local currency. We closed at 56.96. We strengthened to the 56 level yesterday when we closed. This is the strongest level against the greenback in nearly 4 months. How would a lower interest rate environment, a lower interest rate regime affect the local currency over the next 6 to 12 months?
Sure. Well, we're hoping that peso, that it has a stronger trajectory, meaning getting stronger, would probably also improve inflows into the country. So we think that maybe it could attract also investments in the market at least. And so that would be, if in the market your dollars are coming in, you could earn from the trade, but also from the exchange.
Okay.
But we do think that the peso could still just range between 55 to 58 for next year. So, we could still see that range of like weak and a little bit strong. Yeah.
Okay. And Nisha, before we wrap up, can you give us the best piece of investment advice, all-weather investment advice anyone has ever given you? Can you share that with us?
Sure. Have a plan. Have a system that has worked for you. So that means that you already know what kind of investor you are, what timeline you're looking at, what your strategy is. And of course, most importantly, you have to follow your plan.
Right. And as with anything else, the more you know, the more you grow. Thank you very much, Nisha Alisher, the Chief Market Strategist of DA Market Securities. All right, so anyway, we still have some time. The PSEi index is at 6671, up 31, up by 0.3%. How would you describe the overall sentiment in the market right now?
I would say that the market is kind of waiting for a big change, meaning a big catalyst, and so that's the interest rate, and that's the interest rate cut. I also think that the US is could inspire this broadening rally. So while we saw indices go up, largely driven by the tech sector, we do think that we could also see, just more gains across the sector for the Philippine market. So as I mentioned earlier, property is moving up. I think conglomerates will be next, and so it would actually be very appropriate to really start positioning in those. Another thing that I wanted to mention was the timing of it. So based on some numbers that we did, there is a valuation trough that you see after July rallies in general, like for the past 20 years. You'll see valuations come down August, maybe coinciding with Ghost Month, which means just like a slowing down in investments. Rebalancing in portfolios, and then you can come in the market August, September, October before a rally that usually comes in either Christmas or for the first part of the year.
Yeah, patterns say a lot. All right, because of those tech difficulties, we got to sneak in another question with Nisha Alisher, the Chief Strategist of DA Market Securities. Now we're taking a breather. Basis points. We'll be right back. Let's take a look at the business headlines in the major news websites. On Inquirer, foreign direct investments fall to their lowest level in 16 months. The FDI's posted a net inflow of $499 million in May, down by 1% year on year as high inflation rattled investors who are already worried about geopolitical tensions. On Business World, the Bangko Sentral ng Pilipinas says there is, quote, more room to stay tight after better than expected gross domestic product or GDP in the second quarter. The central bank says the latest GDP print supports the case for keeping interest rates steady as the risks of a hard landing lessen. And on CNBC, home improvement retailer Home Depot tops quarterly earnings expectations, but the firm cautions that sales will be weaker than expected in this second half of the year as high interest rates and consumer uncertainty dampen demand. On to some earnings data. Retail holding firm Costco Capital maintains its upward momentum in the first half of the year. The company reports a 15% growth in profit to 6.97 billion pesos. Meanwhile, second quarter profit jumped 21% to 3.6 billion pesos. Costco Capital's grocery retailing business was the top contributor, accounting for 71% of its total net income. Renewable energy firm First Gen Corporation sees its first half net income drop by 10% to $150 million. They attribute the decline to lower electricity prices and to lower sales volumes. But First Gen's president and CEO, Francis Puno, is optimistic about the company's future. This on the back of the positive performances of their natural gas segment and the potential stemming from their new geothermal plants. And the profits of feeds and food maker Vitarich ballooned in the first half by nearly 6 times year on year, reaching 167 million pesos. Vitarich says that the profits came on the back of a 10% drop in raw material costs amid higher productivity levels from its farms. Before we go, Google unveils a new lineup of Pixel smartphones loaded with advanced features, improved performance, and helpful AI capabilities. The new AI integrations will enable users to search for information stored in screenshots, and users can also now pull up Google's chatbot Gemini to answer questions or to generate content. The base model for Pixel 9 will retail at a starting price of $799, $100 more than the previous model. Other models include the Pixel 9 Pro XL and the Pixel 9 Pro Fold.
Pixel 9 Pro Fold. It's the pinnacle of mobile computing, so let's check it out. It's noticeably thinner and lighter than our first-gen foldable. When it's folded, it has the same size display as Pixel 9 Pro and comparable thickness too. It feels and functions like a phone. Then you unfold it, and Pixel 9 Pro Fold becomes something else altogether. An 8-inch tablet with a big and bright Super Actua Flex display. It's the largest display on a phone, and it's 80% brighter than the first generation. This big screen gives you so much more surface area for entertainment, productivity, multitasking, and content creation.
The new Gemini Assistant can go beyond understanding your words to understanding your intent, so you can communicate more naturally. It can synthesize large amounts of information in seconds and tackle complex tasks. It can draft messages for you, brainstorm with you, and give you ideas on how you can improve your work. With your permission, it can offer unparalleled personalized help, accessing relevant information across your Gmail inbox, your Google Calendar, and more.
And that's it for Basis Points. I'm Maiki Oreta. Stay tuned tomorrow for news on the financial markets and more. Keep it here on BNC, the Bilyonaryo news channel. Executive Insights is up next.